Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, June 6, 2024. It's 2:47 p.m. Eastern Time as I'm starting the video. This is video number 2 of the day. I'm going to try to get as much out to you as I can before I leave for vacation next week. And let me shut the phone off there, which I usually do before I start the videos. Okay, got rid of that call. All right, here's what we're going to do. We're going to look at some of the both recently highlighted trade ideas as well as some new trade ideas. I'm really going to focus on sectors here. And most of these are sectors that I've highlighted in recent weeks or even months as potential trade ideas or active trade ideas, including some stocks within there. I'll try to keep it streamlined. I'm not going to cover a gazillion things. I'm starting out with an individual stock. It's not in any, well, it's in a sector called capital markets, which for the most part, those are bearish, but I like this one. I threw it out to you recently here at the 200 support. This is MKTX. This is a stock we've traded many times over the years, mostly long trades. I know we've caught a few short trades, including that last one that I think was there last year after going long, like many trades, once I close out, once the final target's hit, if the opportunity's there, I then will often reverse it. So that was, the story of this one. It just trades so well to the technicals. Like, a lot of these trades I highlight, at least my style of technical analysis. There's a divergent low, big rally off that low. There was your trend line break to give you an objective entry if you wanted additional reasons. There was a minor trend line right there. Big move up. It just trades well. Divergent high, beautiful uptrend line again. So when I say beautiful, I'm talking just well-defined, clear divergence, no wishy-washy, conflicting things in the charts. And then even all the better when you see not just a limp through a trend line, but a solid impulsive move to confirm a breakdown. And, the trends in this one are big. That was a 50% drop. Before that, the rally off that divergent low was 81% roughly off this divergent low. Again, here highlighted back in 2023. It was roughly a 50% rally, followed by the break of that little wedge right there. Boom, your minor uptrend line, divergent high, secondary trend line break. If you missed it, back test there, followed by a big rejection. And as recently I've highlighted it here at this 200 support. Still very much like this one for all the same reasons. Got big divergence. Last time I mentioned it had a positive divergence there. It broke out of the trend line. It came in and it pretty much back tested. That's it. So this is your your downtrend line right here. You've got the hold on, let me change the marking tool here. You've got the primary downtrend line with the divergence line below. It gives you positive, aka bullish divergence. You had a breakout, and sometimes you break out and never look back. Quite often, like this time, you break out and you back test, and that was highlighted there too. Back test, and then it ripped. Breakout, back test, positive divergence right there. And so if I liked it recently, I like it better today, a lot better. Why? Two reasons. Number one, we had a ever so slight, it wasn't enough to trigger any stop, under 200, a slight break below the 200 level, but it was a break below that well-defined support. You can see it right there. It's all the way back to last year. It's capped all the pullbacks and recently broke it. Why is that bullish to me? When it happens, it's bearish on face value, unless you suspect it's going to be a false breakout. But they take it on face value, bearish. But then fewer things are more bullish than a failed breakdown because the shorts pile in, the longs get their stops blown out because they had a stop somewhat below 200, and then you reverse. And now look at the size of that big, fat, bullish engulfing candle. So all those things are there to like about it, and the successful backtest of the trend line. So check across the board. I'm going to sweeten the pot a little bit for you right here. TLT, I've been watching this downtrend line here. Well, hold on. Let's go back. Let me turn off the lines here. So TLT, I'll leave them on. We were long here right off the lows. You remember last year. This was when nobody on CNBC or anywhere wanted to buy treasuries. They thought yields were going to the moon. We went long right at the lows there, put as a setup. The targets were based on the 60-minute, but I even gave you a potential second target that was hit on the daily that was right here. So December 14th. No, it was back in October. I'm long in this breakout here. We milked almost the entire run up here. Biggest rally in treasuries. Got out there at T4, turned around and shorted it here. Gave you 3 pullback targets after closing the long out from there. T1, T2, and a potential third target zone, but I never made that an official. T2 was hit the bottom of the zone and then went long. Most recently posted going long on the site there, right at the lows, as an indirect hedge. After I started the last time we had a short off to T2 and went long treasuries there, and then shorted the pullback there off that level. So treasuries have been just a great trade this year. They trade very well to the technicals. And then look, we broke out when I was gone the other day. We broke out above the downtrend line we've been tapping. And so that's a breakout right there. I believe this is a flight to safety. I'm going to show you some things in a second. I think it's institutional accumulation of treasury bonds. Either way, it's a breakout. And so that should open the door for more upside in treasuries. Now let's go back to this. So you can see there, here's that trend line break as well. Now let's talk MKTX. MKTX, what do they do? Well, their whole business is treasury bond trading, electronic trading for treasuries and bonds, things like that. That's kind of their thing. And so when I turn off all the lines here and I put on comparison here, we'll pull up MKTX. And so that was that last. There was that, what I just showed you a minute ago on MKTX right there. We had a candlestick chart. The white line is MKTX. There was the breakout back test and that 50, whatever, 80, whatever it was, percent rally. And you can see the correlation here between treasury bonds. When they're falling, it's because no one wants to buy them. They're dropping, so their trading volumes are going down on MKTX. But when treasuries bottom, as they did right there, as I showed you, we went long their treasuries. What happened to MKTX? See the white line? That's unmistakable. Well, what happened, as long as treasury bonds rallied, they were buying MKTX. As long as the minute treasury stopped rallying and went down, MKTX started going down, and so forth and so on. So it's you can trade this thing the same way you trade GDX to the gold, or gold to GDX, or I should say GDX to gold, because this thing tends to follow. So I gave you a couple reasons there, showed you the chart of TLT, what it's doing. And again, you can see it going down. Now TLT started to rally recently. MKX has, just like back then too, guys, just like back then, MKTX didn't get the memo. Well, it started to, and then it had another pullback to test those lows. Then treasuries put in the bottom, and then they both rallied. So either way, close enough. You can see the correlation there. Let me turn off the lines, edit chart properties, go back, comparison, shut that off. And so that's it. If the breakout in TLT holds and they continue to run, be it a flight to safety, be it natural accumulation from natural buyers, whatever reason you want to say, it should be, as it has in the past, it should be net bullish for that stock. So there's a single stock trade idea. And look, okay, remember the bearish engulfings the other day in the stock market a couple weeks ago? And I said it's super easy. I even went so far to say you can call it you can say the trade has a below equal chance of playing out, lower probability, unfavorable, or not a great probability because it's a counter trend trade. However, that's offset with the above average risk reward potential, because if you take a shot and you have a stop, same thing. On this one, the markets, I smelled the false breakout, which may or may not happen yet. We'll see. Only time will tell. Meaning the pop above the bearish engulfings from a few weeks ago. And I told you I was going to, I suggested to set a stop a little bit above that to just allow room if they do want to punch it through and clear those stops. You could do the same with MKTX, although on this one I would keep them a little more tight. I don't think... This is not the stock market. It's possible. So look, it's up to you. If you want to take it here and put a stop, it just ticked up a little more. You're talking, if you put a stop right at the lows, we're only 5% above the lows. So you can give yourself 1-2 below that, or just keep a 5%. Where to? Well, I already gave you my targets before. They're the same. This 228.50-ish. I'll have to, I need to sharpen my pencil and maybe revise. Just catching as a bottoming play. If it plays out, let's just say we're going to come back up to this area we did before. At minimum, and then look, there's a minimum target. If you want to just use that for your RR 11%, then you need to keep yourself maybe a 5% stop. You have a little better than a 1-to-1. 2-to-1, I'm sorry, better than a 2-to-1 RR, which is fine. But like I said, this one could get some traction. And it's one of many. It's like anything. If it doesn't work out, let it go. it's not it. Set your stops, set and forget. I love those OCO orders. I'll be traveling, and I'll guarantee you that's whatever I do take home with me this weekend. And before I get on a long two legs to Italy, got to fly from Miami to I think New York, and then out. It's just a whole day of travel and then some. So you can bet your bottom line dollar, whatever positions I have will have OCO orders. So the best things in sliced bread. It means one cancels the other. You have a stop loss wherever your stop loss is, and then a profit target where you plan to take profits. And set it and forget it. Make sure they're good to cancel orders. So one of two things is going to happen. When I land in Italy, I'll either be stopped out on a trade. Let's just say there was movement at that period. Or let's just say I don't even turn the computer on for 10 days. I'll either be stopped out, and then this order gets automatically canceled, or that price target will be hit, and then I get filled, and then this one's canceled. That's the only way. You can't, if you don't use OCOs, you have two orders that you could have this one clipped on a stop rate, and then you're out of the position, but then you go up there, and if you're using Interactive Brokers, a sell limit order, whether you have a position or not, it's going to sell it out. It'll put you short. If you use Interactive Brokers and you're an active trader like me, you know what that means. You don't have to differentiate. You don't have to put a sell short order like you do at Fidelity or elsewhere. You just put sell, 500 shares of XYZ at this price, and if you already have 500, it's going to sell those for you. If you have 0 shares and it's a stop order at that price, stop limit order, it'll put you short 500. So anyways, that's where the OCOs work. Okay, enough on that. And like I said, it's one of anything, take it, leave it. I just want to show you the breakout in the long bond, and that's tends to bring in buyers to this company because they're doing more transactions. All right, let's go through this. Let me see if there's anything I want to try to keep it on topic or related things. Yeah, let's do that. Let's go with the markets. You already know my thoughts on SPY and QQQ. They're red today, so far, well, it's what I obviously wanted to see. I'm giving them a little room, I told you, to see if those yesterday's pops were just stop clearing moves. Technicals still support being short for based on the case that we entered. My opinion, the trend indicator flips, all that. But let's look at one we don't look at a lot. I don't look at a lot because I don't trade it much. Sometimes I will. It's the Dow. DIA is your ETF for the Dow Jones Industrial Average. It's only 30 stocks, so it's not very diversified. It's not very representative of the economy. Then again, of course, QQQ is not at all representative of the U.S. economy. It's representative of the tech sector. So, trade what you're trading. Sometimes because of the weighting in these, look, if you want to trade it, YM are the futures, DIA is ETF. If you want to chart opinion, let me know. Here's what I wanted to show you. Okay, so no change in the Dow. We put in a divergent high right here. I don't have my little DHs, but that's where it would say DH. And that's a marginal new and still divergent high, slightly higher high, breakout that failed. And this is a daily chart. So unlike, the NVIDIA heavy and tech heavy, the NVIDIA is not in here. So you can see the difference between the Dow and the S&P, right? Different story, right? And that's because NVIDIA has a huge weighting in the S&P 500 and NASDAQ. So this is really more of the, if you want to say the stock market minus NVIDIA. Either way, there it is, big divergent high. There's actually a broadening, ascending broadening wedge pattern right here. That's what that is. So there's your uptrend line, and then you have price support here. So on the Dow, if you do trade DIA, about 377.50, and the uptrend line are your two levels to watch. There's the 200 days below, which I still maintain. I have a high degree of confidence. The indexes, including SPY and QQQ, will be visiting very shortly, despite the current beliefs out there. I can tell you, I read the headlines. I'm not just trying to lump everybody in. I know there's some that don't see it, but that's everything I read now. It's like the headlines in the last few days have been a soft landing is now all but guaranteed and locked in. Oh, okay. We'll see. Anyway, that's the Dow. Okay, why am I talking the Dow? Well, let's go back old school here. I pulled out the other day. I kind of pulled out of my old, collection book from years back, even decades ago, the Hindenburg Omen, and I gave you my tweaked version I created, which is using the NASDAQ and all the criteria on the NASDAQ instead of the old NYSE. So I showed you that fired a rare but pretty accurate, indicator, a signal, if you will. And the Hindenburg was created as a market crash indicator. Again, it's something I haven't even talked about in probably a decade or more. And so I showed it to you the other day. Let me move on. Before I move on there, I just want to show you this little minor uptrend line that broke there too. I wasn't tracking the Dow, so I didn't see that, but pretty hard selling and a little bearish pennant going right there too. See that? Or the bear flag, I should say. And since we're going retro, just go back. You can Google this if you're not familiar. This has been around for a lot longer than I have, called the Dow theory. You can Google it. This one's from Investopedia. It just talks how it works. It basically says, Charles Dow created the Dow indices. He came up with, I guess it was Charles Dow, and read there, and along with Edward Jones and Charles, whoever this is, they founded the Dow Jones Company. Blah blah blah. They came up with, or somebody came up with a Dow theory that basically says, that when the Dow Industrials, the Dow Jones Industrial Average is going up, that the transportation stocks should go up. And I know it's a different economy than back in the 20s and 30s and whatnot. Now tech is a much bigger part of the economy, but back then, and it still holds true to this day. And that's why I've showed you before, I have a handful of leading indicator stocks and a watch list, and that's among those, and the two big ones are UPS, FedEx, because they are showing you, if they're doing well, the economy's doing well because packages are being shipped and moved. You're buying stuff from Amazon and other shippers. You're doing mortgage closings and real estate closings and commercial transactions. Therefore, documents are being sent to be signed, all that good stuff, right? It's simple. It's a very simple business model they have. And so if the economy is strong and growing, they should be growing. And they're not. They're way off their highs, both of them, as are my other, some of the other indicators, particularly paychecks and ADP, the two payroll indicators. Anywho, this is the kind of the same thing. And the Dow theory says that if the industrials are making new highs, then the transportation sector, the Dow transports, would have been around forever. Now the transports are really trucking, airlines, and shipping for the most part, and railroads. So those are transports, things that are moving around there. And but they go on in there. This definition says the bull market has these phases: accumulation, public participation, or the big move, where retail and average investors begin to notice the uptrend and join in, generally the longest phase. And then the excess phase, where the market reaches a point where experienced investors and traders begin to exit their positions while the larger investing population continues to add to their positions. Like I said, I've been hearing stories secondhand from people I know that aren't far from pros. They have a day job, a career, and they're getting advice from their neighbor or their barber or whoever telling them to buy NVIDIA. I'm hearing more and more of that. And so I don't know exactly where we are, but we've got to be in that excess phase or darn close to it. And that's, again, what I think is going on here. And but back to the Dow, that's part of what they're talking about, is they basically say that the if one index such as the industrial shows a new uptrend, but another remains in a primary downtrend, traders should not assume a new trend has begun. It also goes on to say, I might have skipped over it in here, when one makes a new high, the other should, somewhat shortly after also. In other words, the transportation should make a new high to confirm. Or if the transports make a new high, the industrials should confirm, right? That's what it is. So again, you can read up on it. All right, so DIA is a Dow. We can see it peaked right now. It's not super high off its peak, but it peaked back on May 16th, a few weeks back, all right? But it's still not too far off the highs. The trannies, YT, peaked all the way back in the beginning of March right there. There's their peak. You can call it a double top if you want right here. March 22nd, you still have a peak there in March. And it wasn't random. Look at that. That was a beautiful, and I believe I highlighted back then, the breakdown, my kind of chart. Bearish rising wedge pattern. Created that back in March. So yeah, March of 2024 is when I created that trend line. So I would have highlighted in one of my videos. Beautiful bearish rising wedge. This is textbook. This is what I love to see. Breakdown, kickback, rally to back test, and boom, that was it. That was the high. So the trannies are telling us a different story right now than the stock market. And again, there is importance there. And I kind of what brought me into this. Remember earlier today, I told you I was going to show you some sectors at the end of the last video. I didn't get around to it. One of them was shipping. I've got some shipping stocks on my radar. They look to be ready to roll over. But you can see overall, the broad transportation index, you can see has been walking its way lower. And there's a downtrend line to watch. Plenty of resistance if the downtrend line gets taken over. So this thing is, again, months off its highs. 13%, just coming off a 13% drop, and it's a sign of and a big divergent high on the weekly. Again, nothing's changed. You can go across just about any index. Major sector has big negative divergence on the weekly charts. So anyways, you take it for what it's worth. Let's sub dive down into the trannies. Let's look at trucking first. In no particular order, I'm just picking these. Trucking on TC2000 is IX2270. Gives you a chart with the components. You can see, this is what I do when I do these videos. My components, when I type in a sector or an ETF, it'll show me the components there on my watch list on the right. And I have it sorted by market cap. That way I know kind of the bigger ones, the ones up front, are going to have a higher weighting usually because of bigger market cap. Now, you got a little positive divergence here, so maybe a head fake, who knows, we'll see. But the bigger, it's coming off a much, much bigger divergent high right there. You can see big negative divergence leading into that top. And this is trucking. So, you know, AI is saving the market right now. Everyone thinks it's going to save the world, and maybe it will. But when when Main Street goes into a recession, when the economy, because again, if things are booming, trucking's doing well. And keep in mind, and sometimes trucking will be going down when you see a surge in gas prices. That's not the case. We've had falling crude prices throughout this whole period. Trucking, that should be a net boom to trucking, and it's not, because that's one of their biggest, like many, it's their second biggest costs, labor, and then fuel. Just like the airlines. And so we're not seeing that. And so that to me is a red flag. And then technically, speaking from a technical perspective, that's a pretty well-defined trend line. If you want to make a BOD or benefit of the doubt trend line, you can do that. You can come in here and we can just add it right here. It really just catches that one little spike. I don't like it. It's not enough. I'm just going to take it away, leave the trend line I had. I think this is the cleanest, most reactions right here. On this trend line, then a break, back test, breakdown, back test, and we're holding. This is pretty good support, so I'm going to set an alert, and when this level goes, that's not it. It's probably going to open the door for the next leg down in the trucking sector. And again, the takeaway I'm trying to give you is I watch economic indicators. We're in bizarro world, but I've seen this movie before. I've seen it over time where the market is cheering bad news. And I'm watching employment. I'm watching all the indicators to me that matter, that are the accurate forward-looking indicators. A lot of people get coincident and even lagging indicators confused as having any predictive value. They don't. And then we have to kind of know what to look for in employment numbers. But whatever, we'll go there later. So it's clear, it's been clear that the economy is slowing, and that's supporting the reasons for a rate cut. But as I said, it's the same thing every time. Once the job market turns from low levels, history shows, without exception, I've showed you this chart in the past many times, that's it. When the turn is in, that's usually it. And then the one thing, and it's always the last pillar to go in an economic expansion, is the jobs market. And when it turns from the bottom, it's a trend that just, once that new uptrend starts, it continues and it tends to pick up pretty fast. And so what'll happen, the narrative will be, right now, bad news is good news as far as the economy goes, because the market's going to get its rate cut, and then they're going to realize, well, we didn't realize that, we kind of forgot that consumer spending, it's over 2/3 of GDP. So, people start losing their job. Yeah, we're going to get a rate cut, but then what's it going to do when profits fall because the consumer's, tucked in? Anyway, that's that. So I just wanted to look. That's just fundamental ramblings. You can look that up, whatever. These are the levels to watch. And again, the important thing is the market just peaked the other day, right? A couple days ago, put in a new high on the S&P and the NASDAQ, not the Dow, but those other two. And look what's going on with trucking. Why is that happening if, we're things are still holding up very strong in the economy? You have our airlines too, XAL. so long since topped, it's not even worth talking about almost, because they peaked back in 2021. COVID hit. Yeah, a lot of that was, obviously what COVID happened, economy, world shut down. Of course, airlines got bailed out by the federal government. They got huge bailouts at taxpayer expense, and this still happened. Then you had a little reprieve where oil was falling, a little rally. But this is a bear market, the bear trend, whatever you want to call it. We're a whole lot closer to the 52-week multi-year lows and highs, and we just broke from this little symmetrical triangle pattern. So that's another sign of non-confirmation. Given this sector is more of but it is also, doesn't have your UPS and FedEx involved. They have a lot of air freight going, but this is the commercial airlines really in here, but they're also showing you what's going on there. And then you have what else did I want to cover with you? Railroads. That's IX 2250, I believe. Okay, that's also an important one there. Rails peaked back here. Very, very clear divergent high breakdown wedge, just like you had back here, and then that happened. That one you broke down. First kickback rally was there. Railroads fell into the October lows. We had this nice rally here, but they're clearly moving lower, and they clearly peaked back here. So again, my point being a sign of non-confirmation. Whether the Dow theory is as accurate as it used to be or not, it's just the crux of what it's telling you, that, hey, if the economy, not the tech sector, not just one stock in there or a handful. They're all, NVIDIA and Microsoft and Amazon, or Microsoft and Apple and Alphabet are kind of in a loop, a vicious cycle, and so they're all going to go together, and they're the only ones pretty much. When you look at, I can go over the semis. I'll get to them in this video and show you the vast majority of semis have also peaked. It's just NVIDIA holding the sector up, and even the sector itself's not made new highs. So there's railroads. What else do I have for you? Let's just do last one, shipping. So I have, let me just key in let me key in a shipper, and it'll load the watch list, because I got an alert on this one today. I had a price alert set on CMRE that triggered today at 11:47 p.m. and continues to break down. This was it. So right here, broke down, and it continues to move lower, but here's my daily chart. So you can consider it a short trade if you want. The bearish PPO crossover, extremely overbought right there. You can see this is a daily chart I'm talking about here. Last time where that overbought was right here, and it didn't mark the top, but if you shorted that extreme overbought with almost identical overbought conditions, in just a few weeks you made 32% on your short trade if you covered it there. And I'm talking about down here, down on the bottom. I'm going to put a horizontal line here. I'll just draw it out. This right here, take that across, and you can see that's the last time we were this overbought there, and it was followed by a 32% drop. And then it made you could have held on to it and just said, okay, I'm targeting, a 50+% drop, because that's the nature of these companies. I've traded shippers for a long time. Used to trade them quite actively back in the day. We had a lot of trade ideas on individual shippers, and I know this sector. And then when they run, they really run. And when they fall, they really fall. So it's kind of like getting a hold of a trend on natural gas, or one of those high flyers that just keep going and going and going. That was a big divergent low. So my point being that, even if you just shorted the overbought condition, the extreme overbought, you only went another 7% high, but if you held it, you would have milked that 54% run on the way down. And so bottom line is, it just broke down today. And what I'm gonna do here is rifle through a handful, and these are the largest. This sector is called shipping and ports. So you have some are shippers, some of the ports. KX, negative divergence. If you can look at it. I won't have to circle each time. If I say divergent high, you can see the divergence lines. Sometimes they might not even be drawn. Beautiful breakdown, and impulsive too. This thing's just getting going. My first target's that trend line there, about 8% lower. And again, the takeaway too is this is a key component of the economy. If the economy, if we're economy is strong, and everything's gonna be hunky dory, and we're not gonna have that hard recession, hard landing I think we're gonna have, then these guys shouldn't do much other than maybe a little correction and go into new highs. But they look pretty toppy to me. You can even go in longer term charts. I don't have them all marked up, but I'm going to rifle through a handful. This one's too new to trade. I usually don't chart stocks that don't have at least a year's trading history. MATX, Matson, big divergent high, coming off that divergent high recently. First target. I don't have them all marked up. Let's just say I'll hold that 97.20 as a longer swing target. I see one more stop along the way right here. I should add for you. BLWP, thinly traded. When you see these little speckle type candles, it means hardly any volume. But the volume lately has come in. Looks like a big buying climax to me. GOGL, not to be confused with Alphabet or Google. It's only one O in there. Golden Ocean Group Limited. Beautiful bearish, negative divergent high, bearish rising wedge, breakdown, hit my first target, or first support, we'll say. I didn't throw it out to you, so I'm not calling it a target now. It's support. Bounced, back tested almost. It's at that level again. Simple stuff. Set an alert. Break of 1380 should take us down to these next two targets here. And if we get some traction going, I'll do an update, give you some bigger targets. But again, I want to impress the point. This is what I try to do, and that's why these videos can be long-winded. Don't underestimate when you get a turn in this sector. That was a turn. That was a divergent high, almost identical pattern, technicals. Everybody wanted to buy them there. Nobody wanted to short them, I guarantee you. I'm speaking, obviously metaphorically. 56% drop. And likewise, you had a divergent low here. Most people didn't want to buy the shippers, but that's when you want to buy. And the point I'm making is if you just swing these things off these divergent highs and lows, these are high double-digit trends, high in double-digit percentages, typically 30 to 50% plus. So that's why I'm showing you initial targets. And, if we start to break some of these levels, I'll give you updates and additional target. Or if anybody asks. A lot of times I do these videos, I talk for 40 minutes, I don't get a single comment, but I post one chart on the QQQ and it makes a new high, and then there's 50 comments there. So, this is where you can make a lot more money. It's like natural gas and wheat and the miners and the metals. Those are the trades. That's where most of my money's come from this year. Those are easy trades. Those are double digits in a couple weeks. The market's been grinding higher. 0.5% makes a new high and it goes up another 0.5%, 2%, and then it drops. That's been the pattern for a while. It's slow grinding higher. So these are where, and again, the other takeaway too, remember, is the economy. If these shippers are dropping, and they're telling us something, because they talked about that in this thing that they gave you here that talks about the Dow theory. It starts out by talking about the efficient market theory, which says that all known things are pretty much priced into a stock. I saw that somewhere in here. And so that is what it's saying, efficient market hypothesis. It says asset prices incorporate all available information. That doesn't always work, especially in this day and age. There's a lot out there now. But, for at the crux of it, the reason you'll see a sector like this turn before you'll hear about it on, and they'll start telling you to sell these stocks on CNBC or Bloomberg or wherever, is those in the know, insiders of the company, businesses that deal in this area, and the smart analysts on Wall Street, they know, they see what's coming. And so that's where you'll get the breakdown. The selling will happen first. And then somewhere down here, Kramer will tell you to sell your shipping stocks when they've dropped 50%, that they're going to continue down. So that's how that works. And technical analysis will pretty much show you, what's happening. And that's a solid sell signal, guys. I don't know any way to say it. It's a big red candle. That's what you want to see. And if you have, again, I'm doing these I'm giving these levels so you can do it in advance. I'm not going to be around for almost 2 weeks now. And you can see they're not gapping down and running away. This one did gap down today, but it's been moving steadily lower since. And there's my first stop. A little hiccup there around 1733, but first minimum target's down there around 1570. And then this trend line would be my preferred swing target now. And that still gives you, despite it's down 19% today, about 35% more downside if that trend line is hit. SLBK, that's Star Bulk Carriers, right on the trend line now. You set an alert. When it breaks that trend line, it's going to have a little reaction. They're going to come in and bounce it there probably. But when that level goes about 25, next stop's there, and then another stop once that level goes. This would be my preferred swing target, about 22.93, giving this one about 10%. And I know that's well below the the high double digits like the other ones. I may certainly add additional targets to these. I just wanted to show you, and I won't go through each and every one. I think CMRE is the one I got the price alert on today. DAC, there's your trend line right there. Extreme overbought conditions on DAC. It looked almost the same. DAC, see this extreme overbought reading? Last time the stock was that overbought was right here. What happened? Well, you got a double-digit correction right off the bat. Even just shorting that extreme insane overbought reading, you got 12% drop. But if you held out and you waited and had a little kickback rally, went up another 4, less than 5% there, and then you gave it a little room, which, by the way, guys, is critical. I talk about beta adjusted position sizing a lot. Maybe I don't do it as much as I used to now. It is imperative. If you trade natural gas, if you trade the shippers, they don't move like treasury bonds. These guys go up and down, high single digits, sometimes double digits. I just showed you one down 19% in a day. So if you're going to take them and you're going to successfully swing trade them, you can't run a 3% stop loss. They're going to take your shares from you long before the trade plays out, just in the back and forth noise. So what do? If you're not comfortable with a 10% plus stop, you take a smaller position size, because it's not about what you lose in percentage term that's going to wipe you out. It's what you lose in dollar terms. So on a stock that you're targeting, that one dropped 52%. If you're targeting a 50% drop, you give yourself a 15% stop loss, and that's better than a 3-to-1 RR. That's how you do it. In that way, and then you take a smaller position size. I'm just drawing out the divergence here on the low. That was a catalyst for the bottom there. That was an equal low. All right, I'm going to stop here. There's a gazillion of them. I can rifle through that bearish rising wedge on NMM, the Navios Maritime. It's beautiful. It's just a big, steep wedge. And again, it's twofold. Consider them individual trade ideas if you're looking for a sector. I know I'm not giving you a lot of long side sectors, right now. If I find one that stands out, well, I started the video with a single stock, but these are what I'm seeing. These are what stands out. And they're also, like I said, relevant, in my opinion, to the economy. Do you think it was mere coincidence that the sector, all these stocks peaked back there in early 2022 when the stock market peaked? No, they went up a little higher after, and then they all fell down, 50+%. So that's it. I'm going to get away from that sector because I wanted to cover a few more. See, a lot of these I haven't even gone through. There's a lot in there. And then as I go down the line, they're smaller companies, but you can see they're all singing the same tune here, telling you the same thing. I'm just marking levels. All right, I got to move on or I'll never get to the rest of the sectors. On a somewhat related note of the economy, I've thrown out and I still maintain short trade on PEJ. I still think this is will hit my second target. I threw it out to you back here. We traded them back last year here on this drop, and I had targets. I guess I changed I must have erased the target levels. We shorted them successfully last year. And again, this year we had this beautiful bearish rising wedge breakdown. We hit my first target, as is usually the case. We had a reaction. We bounced. That's normal. That's why multiple targets are listed. We went up, and I since added this downtrend line. It's been capping the advances. That's T2 right there. And so all I can tell you right now, it's an objective short here because we're at resistance, at downtrend line resistance. So you could add on or short, new short. It gives you about another 5.5%. In the video that I would have covered back here a couple months ago, I would have showed you some of the individual names, which had even more bang for your buck. But I don't have time to go through the individual components. I only wanted to do that on the shippers because there is I don't believe there's an ETF that covers the shipping sector. So you got to go with the individual names there. There used to be one called SEA here. I don't think it's around. Oh, it is. Look. Global Sea to Sky Cargo ETF. Oh, there you go. Looks like a thinly traded one with these wonky candles, but It should, if you're looking for an ETF for it. So go figure. I thought for some reason they delisted that one or just stopped trading. All right, back to PEJ again is a play on the consumer. So while Nvidia goes to the moon, the consumer is slowing down. It's evidence in this is the leisure and sector entertainment portfolio. You got Booking.com, Marriott, DoorDash, Royal Caribbean Cruise Lines, and the whole likes. EATZ is on a related note. I've covered that one too. Through that as a trade idea. We also nailed a short on it last year, along with some of the best individual names like McDonald's and Starbucks, whatever. But again, this was where we had a beautiful bearish rising wedge and a break of support. We hit my first target right there, bounced off it as expected. We're back to about where it broke down. That's also price resistance. So I am going to say this is also an objective re-entry if you're covered on T1 now. We had resistance there, false breakout above that level, another rejection, and that should take us down to the next target, T2, which will be about a 12% drop if and when we get to T2. So if you short here, you're targeting 12%, you can give yourself, let's say, a 4% stop loss, and that's a 3-to-1 RR, and that would be somewhere up about, right? Heck, keep it around 3% maybe, and that would be a 4-to-1 RR, or 4% would be about right there. Okay, so those kind of give you an insight to the consumer, as does XRT. XRT has twice fallen back into this trading range. It's purple box. I know it's a busy chart. I gave it to you as a trade idea, saying we had a failed breakout here, made a marginal new high. It still has a divergence, and it's still a breakout I believe will fail. We whipped in, we hit T1. We hit our first target. But we bounced, and that bounce carried us a little back above the top of the range. But we still have the divergence, and it's still, if you look at it from a more simplistic view, is this, you've got the negative divergence. Those are your divergence lines right here. And this is your uptrend line, your primary uptrend line. So if you want to play it safe, set a price alert, which I'll do right now. I think I already have it. Below this trend line, that'll throw us back inside of the trading range. And since T1's already been hit, it increases the odds that next time we'll pass go, do not collect 200, just go straight to jail down to T2. That's my next target, and T3, and then T4. And, or I'm wrong, this goes up and the trannies go up and all this. These are things, these are tells on the real economy. If the consumer's plugging along. By the way, this thing's skewed with, the biggest components, Amazon, which is part of the whole tech, Mag 7, NVIDIA bubble and all that. It's moved, it's indexed. It's one of the top weighted components there. So it tends to catch a bid with Microsoft, Alphabet, even though it's not much of an AI company, but I'm sure they're throwing the word AI into their mix lately, like everyone else. It's incredible. The companies are trying to include the word AI in their annual reports and quarterly earnings. So that's that. You can see the wedge, and you know where we're going. Trade it as you want. Another sector I wanted to highlight, which I have highlighted recently, is IAI, the broker-dealer index. This one we shorted right here on the break of that yellow uptrend line. We hit my first target, which is right here. We bounced, and I have given updates on this. We made a marginal new, but still divergent high, even larger. That was our first divergence at this point. The divergence is even bigger now. Broke this minor trend line, and so I still maintain T3, T2, 3, and 4 are still my targets down here, swing targets. So plenty of meat on that bone. XLF financials, same thing. Bearish engulfing candle with a ever so slight, just like the indexes, marginal do divergent high, but this one failed right away. This is what I think the indexes will do. It looks just like SPY and QQQ, and fast forward. Here's QQQ, right? There was that divergent high and bearish engulfing candle, the little stop pop raid that we got yesterday that I was kind of anticipating. Same on SPY, SPY, and then so boom, popped it, and so XLF did that same thing recently, put in a divergent high and bearish engulfing candle there, but then it put in another, that's actually, no, not a bearish engulfing, it popped that one there slightly, ever so slight pop above the previous one, and then failed so far. Now look, it's not crashing, and it's not far off the highs, so it's can't write it off yet. But based on the scope of the divergences and everything I see there, we need to take out this trend line, and then obviously you can see I color coded yellow is an important level, 39.53, to get taken out. On a related note, I told you recently I thought it was time to start shorting the regionals again right here at the downtrend line resistance. And they're moving lower, but they really need to break. There's that red line down here. This is big, 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 big support, about 45, down to about $45, I think, on the red line. And so they've been kind of under pressure lately, moving lower. And so here's their high. That's another sector that peaked back in the end of 2022. Shipping I already covered. XRT I covered. GDX. Let me update GDX. I know I updated the other day. I said, look, silver and gold were at support, probably going to bounce. And so the GDX miners would bounce too. But we're back. I've had a couple updates, even though I just covered them the day before I left. But I don't have strong convictions, but here's what I'm going to tell you. My convictions are now that this is probably it. That's my guess. Remember when I did the video, I told you that this appeared to be just the first leg down. And although we did have that positive AK bullish divergence on the 60-minute chart, when we probably bounce from it, that I believe there's going to be at least another leg down. And that was, again, the analysis I did day before yesterday on Tuesday. You can watch that video. And so I think this is it. I think this is, we'll cap here about 36. Gold is 60-minute chart. Gold's back up to S2. Remember, we were here the other day, divergent low, boom. But bigger picture, I think because of the breakdown, again, this is bigger picture, daily chart, divergent high, breakdown right there, kickback rally. Maybe we go up back test, but I think there's going to be most likely, and I don't have super strong convictions, but that's what I favor. I think there's a good chance this may be it for the bounce. I wouldn't go too crazy, long or short right now, but if you game the bounce off those support levels on gold and silver on the futures the other day, at the very least, if you don't want to book profits, maybe raise your stops, tighten up stops and see if you can let it run. I'm talking about gold futures. That's where it was highlighted on Tuesday at trendline support with positive divergence. And you can see we're at that, I give you these three resistance levels. We're at the first one. This, I think, would really catch a lot off guard if this divergent low failed. And then I gave you a scenario. We can go down and, put in a bigger divergent low, and then I might be looking to go long right there. Let's just wrap the video up with the semis. So you've got SOXX. Same story here, divergent high, trendline break recently. We're still below. This one hasn't made a new high despite what NVIDIA is doing. And when I go through the components, remember, it's all NVIDIA in the semi sector. When you go through, there's NVIDIA. This is a busy chart, but I'm going to go through here. Taiwan semis, actually, these are the largest. When you go down the rung here and you start getting down, especially there's AMD, you go down to the best proxy of the semi index is probably XSD, because that's the spiders. It's more diversified, it has more holdings. Even though SOXX tracks the PHYLX, that was the original semiconductor index back from like the 90s, I believe. But SXD, spiders does a better job of being more diversified in their sector ETFs. The S&P spiders. That was a divergent high, and that's still the peak in the semis. Or you call it a double top here, whatever you want. So call this the peak. But again, it's almost an identical technical posture. Big divergences. Divergences have been building, and it's not as if they haven't been working. Each one played out. Divergent high 1, 2, and 3 should be. Each divergence is bigger, and will most likely lead to a bigger drop. Okay, I had to pause it there for a second. All right, let me rifle through this XSD, this Spiders S&P semiconductor ETF. So pretty much finally caught up to its peak back in the beginning of 2021. When you see something so big in scope, you want to go to a weekly chart, and that shows you that was our first divergent high. So really what I call DH1, and it's the same divergence started at this point. These indicators making lower highs. And into the recent high. And so we're going to rifle through and just kind of give you, and I'll end it here with the semis, just kind of an idea. There's NVIDIA. We know what NVIDIA and Broadcom, some of the big names are doing. Remember, I sort my watch list by market cap. So it only makes sense that those with the biggest market cap, NVIDIA just yesterday briefly touched the $3 trillion mark. And so it's going to have that oversized effect on the index. So you take that out. And what you're going to see as I go through the list, more and more of these stocks peaked. There was one with a divergent high, a bearish engulfing candle, and an island cluster top. That's AMD. And since it put that in, the stock is down. It dropped a total of 35%. It's still down 25%. Qualcomm put in an island top the other day. There's a gap on both sides, still below it, and then went on to break this trend line that's back testing it from below. Texas Instruments peaked recently. And Micron, beautiful setup there. Look at that. If it breaks this trend line, nice clean up trend line, big divergence. And give you one other little stop here. First target somewhere there-ish. Yeah, roughly 121, then 106. Intel. Intel threw out as a trade idea. It's gone nowhere. It's still there. It's it's looking from the look of these indicators, probably going to make another thrust down and then put in a divergent low before it does anything. I'm just not excited about this one anymore. It's dead money, really. ADI Analog Devices, just a nice, clean, sharp, steep uptrend line there in which to trigger a sell signal when broken. Big old fat gap to be backfilled if you want to trade it that way. Tops and bottoms of gap often act as support and resistance. And then a minimum ultimately for a swing or trend trade. It's got to come back. I think back test that 201 big resistance. It's a breakout there. And that would give you, this stock has about 15% drop to get there. NPXI coming off a big divergent high. Marvel peaked back here months ago, still well below that high. MCHP. And then you get down the line. So I'm just going to rifle through these. You can see almost the same story. A lot of these, just the big divergence keeps growing. On semiconductor, and a clear downtrend, peaked back in mid-2023 below the downtrend line there. First Solar, really a solar stock, but they put it in this sector. I mean, yeah, they use semiconductors, of course, in solar technology, but that's kind of its own thing. Skyworks, well off the highs back from early 2020. Back in 2021. So, see, I have to scroll back and show a lot of these stocks. They're in, a lot of the semis are in their own separate world, unrelated to NVIDIA. Because if you're a semi and you don't have the word AI attached to your name right now, a lot of them at least, you're not doing so hot. And that one's a big divergent high back there. Allegro. Remember, I'm getting down. When I go down the line, I'm getting to these second and third tier semis. Powi, a lot of them which peaked back in 2021. You can see Slab, Silicon Labs, Credo, SYNA, Synaptics, Wolf, peaked back in 2021. Still on a bear market. If you're bottom fishing, some of these, as long as stay away from any, penny stocks or sub $5 stocks, you're going to find certainly be some bear market rallies coming up in these. So, if you're bullish in the semis as a whole in a market, I think you get more bang for your buck right now in a stock like this. Maybe I have to study a little further than a NVIDIA at this point. Needs to also break this level right there. Anyway, so that's it. So you see now that I'm gotten away from the top 10 or 12, none of them, they're not even close. They're all 60 to 60% off, and that's after a rally. That's after a 233% rally, and it's still trading 60% off its all-time highs back in 2021. And this one's trading, setting up nice, 75%. So that's where you'll at least, the risk-reward ratio, because these guys are subject to short squeezes and bear market rallies, particularly if the market holds up and the semis hold up. This is where, and when I get back, if things have still held up, I'll hunt out. But I'm showing you some names now. You can see my levels. I'm going to move that trend line to right there, and then set a price alert, because I wanted to cover all these reaction highs there. So boom, if it pops, you got resistance 1 there. I might, again, sometimes some of these lines are older, but I'd say that's second target and a potential third target there. But if if the market finally poops the bed, and let's say that those bearish engulfing candles we put in recently worthy highs, again, excluding yesterday's little stop pop, then yeah, you might want to not chase the junk in a bear market. That doesn't usually work well either. It's usually just during bull markets that are when you get this, like we've seen the dash to trash. You guys heard about whatever the guy who's, a Roaring Kitty, I think that was his name. Yeah, I couldn't think of it the other day with the AMC or GameStop. You start seeing crap like that in the headlines. Someone who was unemployed at COVID and had $20,000 and put everything in game and engineered that kind of short squeeze. And hey, great, more power to the guy, great. But when you see that and that's coming alive again today, it just shows you that speculative, juice is flowing through the market again. And that's exactly what we saw back in late 2021, early 2022. It tends to be the signature that a top is very near. All right, I'm going to cap it here. Keep this video just under the hour mark. As always, you can hit the playback speed setting, change it up to 1.25, 1.5, or 1.7, whatever your preference is. Whip through these videos a little faster. And that's it. I'll be around through tomorrow, and then gone next week. I'll get things out to you tomorrow, and I'll do an update. And like I said, I'll see if I can scramble to find any more trade ideas before I leave for you, and almost certainly do at least one more video tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.